Good day everyone, my name is Sidong Shen, and today I will be presenting my research entitled Impact of Dividend Policy on Firm Values of Malaysian Listed Companies. This study investigates whether dividend policy decisions influence the market value of technology companies listed on Bursa Malaysia and identify which financial factors contribute more significantly to firm value. Let's begin with the introductions. The main objective of financial management is to maximize shareholder wealth through increasing firm value. Firm value is an important indicator because it reflects investors' perceptions of a company's future performance, growth potentials, and financial strengths. One important factor that may influence firm value is dividend policy. Dividend policy refers to management's decisions regarding how much profit should be distributed to shareholders and how much should be retained for future investment. In finance literature, there has always been debate about whether dividend policy actually affects firm's value. According to dividend signaling theory, dividend payments provide information about future company performance and can increase investors' confidence. But in the hand theory suggests investors prefer receiving dividends today because dividends are considered less risky than the future capital gain. However, Modigliani and Miller's dividend irrelevance theory argues that dividends policy does not affect firm's value under perfect market conditions because these theories provide conflicting predictions. Further empirical investigation is needed. This study focuses on Malaysian listed technology company because the technology sector has become one of the fastest growing sectors in Bursa Malaysia and frequently faces financing and dividend policy decisions. Several issues motivate this study. First, previous studies produced inconsistent findings regarding the relationship between dividend policy and firm value. Some researchers found positive effects, while others found negative or insignificant effects. Second, investors increasingly evaluate company based on growth opportunities rather than simply dividend payments. Therefore, it remains unclear whether dividend policy still influence market valuations. Third, other financial factors such as leverage, profitability, and firm size may also influence firm value and should be examined together with dividend policy variables. As a result, this study investigates 6 independent variables, which is dividend payout ratio, dividend yield, price earning ratio, earnings per share, leverage, and firm size. These variables are analyzed against firm value measured using Tobin's Q. This study contributes to the literature by testing 4 major financial theories simultaneously in the Malaysian context. These findings can assist corporate managers, investors, and fund managers in making dividend and financing decisions. The study focused on 30 technology companies listed on Bursa Malaysia main market. The observation period covered 10 years from 2016 until 2025. This generated a total of 300 firm-year observations. Financial institutions were excluded because they operate under different regulatory requirements. The study also focused on quantitative financial variables and does not include the governance or macroeconomic factors. Next, I will discuss the literature review. 4 theories provide the foundation of this study. First is dividend signaling theory. This theory states that dividends provide information about a company's future prospect. Higher dividend signal financial strength and confidence. Second is bird in the hand theory. This theory suggests that investors prefer certain dividend income today rather than uncertain future capital gain. Third is trade-off theory. According to this theory, an optimal level of debt can increase firm value through tax benefits. However, excessive debt increases bankruptcy risk. Lastly, packing order theory proposed that firms prefer internal financing first, followed by debt and then equity. Higher leverage may therefore signal financial weaknesses and negatively affects the firm value. The theories forms the basis of the hypothesis developed in this study. The 3 hypotheses focus on dividend policy and market valuations. H1 proposed that dividend payout ratio has a positive relationship with firm value. This is based on dividend signaling theory. H2 proposed that dividend yield positively affects firm value because investors prefer cash returns. H3 proposed that price earning ratio positively affects firm value because it reflects investor confidence and future growth expectations. H4 proposed that earnings per share positively affects firm value because profitability indicates managerial competence. H5 predicts a negative relationship between leverage and firm value because excessive debt increases the risk. H6 proposed that firm size positively affects firm value because larger firms benefit from economies of scale, diversifications, and stronger market positions. This slide summarizes the research framework. Firm value measured by Tobin's Q is the dependent variable. The 6 independent variables are dividend payout ratio, dividend yield, price earning ratio, earnings per share, leverage, and firm size. The arrow indicates the expected directions of each hypothesis. Now let's move on to the research methodology. This study adopts a quantitative empirical research design using panel data. The data combines cross-sectional information from 30 companies and time series information across 10 years. The sample consists of technology companies continuously listed on Bursa Malaysia main market. Companies were selected using purposefully sampling. To be included, firms had to maintain listing status throughout the study period and provide complete financial information. This resulted in 300 firm-year observations. All data were collected from annual reports and Bursa Malaysia disclosure. Secondary data were manually extracted and compiled. The dependent variable is firm value measured using Tobin skew. The six interdependent variables are dividend payout ratio, dividend yield, price earning ratio, earning per share average, and firm size. Each variable was calculated using established financial formulas. Several statistical methods were used. First, descriptive statistics were applied to understand the characteristics of the data. Second, diagnostic tests were conducted to assess normality, homoscedasticity, and multicollinearity. Third, Pearson correlations analysis was performed. Finally, ordinary least squares multiple regression was used to test the six hypotheses. The significance level was set at 95% confidence. Now let's move to the results and discussion sections. The regression assumption was first examined. The histogram and PV plot showed that residuals were normally distributed. The scatter plot showed no evidence of heteroscedasticity. Therefore, both assumptions were satisfied. However, several multicollinearity was detected between dividend payout ratio and price earning ratio. The RBIF value exceeded 21, which is much higher than the acceptable threshold of 10. In addition, the correlation coefficients between this variable was 0.96. This indicates a substantial overlap and may affect the significance of both variables in the regression models. The average Tobin skew was 2.214. This indicates that market value generally exceeded asset values among sample firms. Dividend yield averaged 3.2%. Dividend payout ratio shows significant variation across firms. The price earning ratio demonstrates extremely high volatilities, reflecting the speculative natures of the technology sectors. The average leverage ratio was 0.437, suggesting relatively conservative capital structures. Firm size showed a stable distributions after logarithmic transformations. The correlation analysis provided initial insights into the relationship among variables. Leverage showed a significant negative relationship with firm value, with a correlation coefficient of negative 0.198. Dividend yield showed weak negative relationships. EPS, DPR, and PE ratio demonstrate very weak relationship with firm values. The most important observation is the strong positive correlations of 0.960 between dividend payout ratios and price earning ratio, confirming several multicollinearity. The regression model was statistically significant with an F value of 3.596 and a P value of 0.002. Three hypotheses were spotted. First, leverage had a significantly negative effects on firm value. Second, firm size has a significant positive effects on firm value. Third, dividend yield shows significant negative effects on firm value. The remaining hypotheses involved dividend payout ratios, price earning ratios, and earning per share were not supported. Overall, the findings suggest that leverage and firm size are more important determining for firm values than dividend policy measures. H1 dividend payout ratio was not significant. This may be due to several multicollinearities with the price earning ratio. For H2, dividend yield shows a significant negative relationship with firm value. This contradicts bird-in-the-hand theory. The results suggest that investors may interpret high dividend yield as a sign of declining growth opportunities or falling stock price. For H3, price earning ratio was not significant after controlling for other variables. For H4, earning per share was not significant. This suggests that profitability alone does not guarantee higher market variations. For H5, leverage shows a strongest negative effects on firm values. This supports pecking order of theories and indicates that investors penalize firms with excessive debts. For H6, firm size positively affects firm value. Larger firms benefit from economies of scale, better financing access, and stronger investor confidence. Now, let's move to the conclusion and recommendations. The findings: companies should adopt a conservative leverage strategy and prioritize internal financing whenever possible. They should also balance dividend payments with future investment opportunities. Managers should integrate payout decisions with long-term growth strategies rather than focusing solely on accounting measures. Furthermore, firms should improve transparency in financial reporting to strengthen investor confidence. For future research, scholars may extend the study periods, include multiple industry and corporate governance variables, examine macroeconomic factors, and apply advanced panel data techniques. That concludes my presentations. Thank you very much for your attention.